This is something that has not been covered in the mainstream media at all.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Hi there, my name is Shane Moran, and I'll be your host for this episode of Live from the Vault, and welcome to the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Now, this week, we have the one and only Andrew Maguire, precious metals expert and whistleblower in the vault. And to help him today pull back the curtains, we will be joined by a returning guest from the vault by popular demand from you, our Live from the Vault community. So congratulations. We have the one and only Alasdair Macleod in the vault. That's right. Alasdair Macleod is in the vault, and you're not going to want to miss a word of this conversation. So just before we introduce our featured guest and head over to the UK, I'm asking you to please help keep spreading the word about this channel by hitting that like button right there. If you haven't already done so, do it now. Share this information, share this channel, and also subscribe. And if you want to be notified in real time as each episode goes live, just click on that bell button and we'll do just that. So for those very few in our community who have not heard of Alasdair Macleod, he is the head of research at Goldmoney. Alasdair started his career as a stockbroker in London at the London Stock Exchange back in 1970. And subsequently, he's been an investment manager and an executive director of an offshore bank in Guernsey. Alasdair is dedicated to explaining why gold is money and the rest is credit. He's also dedicated to explaining economics relevant to the preservation of wealth and dedicated to explaining the geopolitical developments relevant to you, the investors. So you can find Alasdair at Alasdair Macleod at Substack.com. So he's on Substack right now. And with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our featured guest, Alasdair Macleod. Over to you, Andy.
Well, this is great. Thank you, Shane. And obviously this is very much what I've been looking forward to for days and days now, is having our good friend Alasdair Macleod come back. We've had so many people asking for you. So really, thanks for coming back. And we got so many questions and subscriber questions. And I think one of the good things is that you know, because you have such a wide, it's not just gold and silver. I think you understand very much how everything connects into gold and silver, and how, you know, the various crosses affect gold and silver. So this is very, very useful, and it's rare to find someone who really has that depth of knowledge and also the experience to. But thank you for coming.
Well, thank you very much for having me on. It's always an enormous pleasure for me, and you know, particularly when you come up with such kind words. I love it.
Yes,
I've just got to earn it. That's the thing.
I know. Well, the thing is, I still owe you a lunch, so that's still on the card. So
we'll do it one day. Yeah,
you're 5 hours away at the moment, so I'm sure we'll connect somehow very soon. But I think what was interesting, I mean, there's so many things, strings to draw on, Alasdair, but maybe it's just what was interesting, because it's something I saw a couple of days ago. In fact, last year around this time, I think you and I kind of discussed Russia. And back then, in fact, it was even back in 2021, it was one of those episodes. It was really up in the air as to what increasing sanctions would have on their economy. Yet now, and despite economic and NATO war against Russia, the World Bank ranks Russia as the world's number 4 largest economy based on purchasing power parity.
Yeah.
What are you seeing, Alasdair?
Well, it is fascinating. I mean, I think what we have to do, Andy, is detoxify our minds from the propaganda which our governments put on us. I mean, I mean this from the point of view of being entirely objective in anything we do.
Yep.
the Russian economy, well, as we discovered with South Africa in the apartheid days, when, the world introduced sanctions against South Africa, the inventive people in South Africa developed new technologies and everything to get, to deal with the problem. And the sanctions just didn't work. I mean, it just hit everybody else. And this is exactly what's happened with Russia. Now, I actually don't think Russia gives two hoots that they've lost all those dollars. I mean, because, the US has defaulted on its obligations. Let's face it, that's what's happened. They'll make a bit of noise about it. Of course they will. But from the Russians' point of view, this is sending a signal to all their partners. And we're talking about 60%, or nations representing 60% of the world's population now, 35% of the world's GDP by purchasing power parity. That the Americans, basically, they will steal from you. And a lot of these nations also know that unless they kowtow to the Americans, there might be a revolution or, some sort of regime change forced upon them or whatever. So, I mean, there is a fear of the Americans, but that fear is being broken now by the fact that Russia, in conjunction with China, are, if you like, a viable home for all these nations who are, if you like, sick of the colonialism, if you like, of the West. But as far as the Russian economy is concerned, I mean, it's a libertarian's dream, really, in the sense that personal tax is 13%. If you're a higher owner, it's 15%. What are we paying over here? I mean, and corporation tax is, I think, 25%. So that's perfectly normal. The debt to GDP, and this is a country which has been funding a war for the last 2.5 years. Debt to GDP is 22%. They've got a surplus on the balance of trade. Okay, we know that it's because they export oil and all the rest of it. And, sanctions were meant to stop that. I mean, how the hell is like? So that's the answer. That's why the Russian economy is so strong. And this is despite the Reserve Bank's, the Central Bank of Russia's interest rates of around about 16%. Why is it 16%? It's basically to stop the ruble sinking. Why does the ruble sink? Not on economic terms. It sinks because we just don't like the damn stuff. So if we've got it, we'll flog it. We won't buy it. It's faith. And this is a point I'm trying to get across to people who understand the difference between a fiat currency and one which is actually on a gold standard. With the fiat currency, it depends on faith. That is the watchword, not quantity, though that does come into it, let's face it, but it's faith. I mean, if you're unfashionable, if you're out of fashion, you got a problem. And that's why it's 16% interest rates in Russia. They will go on a gold standard, of that I'm convinced. And when they do, just so that everybody understands what this means, it means that Russian institutions, Russian banks, Chinese banks, banks in the Middle East, and so on and so forth, can go into Western markets, buy gold where the lease rate is 2%, sell it to the Reserve Bank the Central Bank of Russia, where the return currently is 16%. And because it will be tied to gold, it's like being paid 16% in gold. That's the way in which you build reserves. That is the role of interest rates, not trying to manage an economy, which is always a disaster. So they are in a very strong position. And, I think the fact that they haven't actually gone onto a gold standard yet is because India doesn't want it. The Chinese have a different approach to this sort of thing. As far as they're concerned, they don't want to rock the boat. They don't want to be blamed for collapsing the West and so on and so forth. But as soon as someone like Russia goes on a gold standard, we are toast. I mean, it's as simple as that. So And they're also talking about this. I understand that the agenda for the BRICs meeting in Astana, or wherever it's called itself, back in October, the Russians are going to be putting, or they're going to attempt again to put the trade settlement currency backed by gold. Presumably, I mean, the word is a mixture of gold, 40% gold, 60% currencies. But they'd have to go onto a gold standard. I mean, this is the point everybody misses. So we could well have gold standards throughout Asia by October or shortly thereafter. This is an interesting situation. So how's that to start off?
No, that's true. And this is interesting because no, it is. It's fantastically interesting. I think because at the St. Petersburg summit last week, that ended last week, we got the head of the BRICS Central Bank, Delmo Rousseff, met with Glasnev quietly in a room. This is what it's obviously been reported by a couple of people on who are close to it, and. Apparently, when they meet in September at the obviously that's the meeting that's basically to deal with currencies. So basically, which is the new development bank meeting in Shanghai. Then that what our understanding is, and it makes a lot of sense, is that they will want to have it sufficiently formalized to actually launch at that Kazan meeting in October, because what I've been hearing from my contacts, and I don't know what you're hearing, but they want to get this done before the election, before the November election in America. That makes a lot of sense because, the unknown of what a Trump administration might do, sanction-wise to China. Obviously, we've got the Taiwan, the whole Taiwan thing is escalated to the point where you've got not just sanctions coming on China for help for not restricting supplies to Russia, etc., over Ukraine, but also you've got Russia sanctioning Boeing and some of the major companies for providing weapons to Taiwan. So clearly, this thing is getting quite dodgy.
Yeah. No, you're right. This is, to my mind, of great concern. I mean, the Europeans now talk freely of sort of, if you like, national service and sending troops along with weapons into the Ukraine to fight the Russians, supporting the Ukraine in attacking Russian installations and all the rest of it. This is escalating to the point where it risks really getting out of control, and then this is just horrid. And I think also from President Biden's point of view, he's on very much a slippery slope when it comes to the elections, the presidential elections in November, and what do politicians do? I mean, when things are not working domestically, and I think by then inflation will have started. I mean, measured by CPI, it'll be rising again, and the economy will be tanking, stagflation. I mean, this is the initial thing. I'm convinced that is what's going to happen. So what does Biden do? Well, I mean, under these circumstances, politicians always do the same thing. They go and attack foreigners and say, they put the blame on foreigners. He'll probably introduce price controls and all the rest of it to stop inflation and so on. We know this doesn't work. He knows it doesn't work, but it doesn't stop them doing it. So, the whole thing, when it comes to war with Russia and China and so on, I mean, I think we're only seeing the beginning of this escalation. This is going to continue, I think, and it's driven really by self-deception in the West. I mean, we're deceiving ourselves, for goodness sake. I mean, I don't know about you, Andy, but, I look at the Telegraph every day, and the reporting in that is so mainstream, and it's obviously very much in line with the intelligence services, with Westminster as well as well as Whitehall, and this this is really showing us that we've completely lost the plot when it comes to understanding the geopolitical situation. We're desperate. Americans are desperate. They don't want to lose the dollar's hegemony, but they are losing it, and this is going to destroy the dollar. People keep on telling me that interest rates have got to go easier and all the rest of it. I agree with that in a sense, if we had the opportunity. But the reality is that America is trying to fight a war with a debt trap. It's in a debt trap. It rolls up the interest. I can easily see U.S. Treasury bonds, priced at sort of 10 to 15 years out, looking at 15% and more. What's that going to do? The dollar is going to collapse. The question, I don't think, is will it or won't it collapse? It's when. That is really what we're now seeing. We're coming towards an end game, and we can see this rising. So it's a very dangerous situation. And you and I think, are really in the business of trying to help people understand these dangers, educate them, if you like, when they need educating. Most people, I think, actually do have an inkling of what these dangers might be, but they're just not aware of it. And we have to work our way around all the propaganda, which, basically says otherwise.
You're right. And I think this is not about making money. This is about wealth protection, because we seriously have to take responsibility for ourselves. It's clear that when there's a single narrative, no matter what it is, and I'm not even to go there, and it goes all the way back to Goebbels. But when there's a single narrative, it has to be questioned. But if you cannot question it, that's even more disturbing.
Yeah.
And I think what you're just outlining here is exactly that. But to even think, you mentioned, I see it all the time. Oh, maybe we should restart recruiting more troops. And talking about trench warfare. Wars can't get fought in trenches. It'll be nuclear. It's pointless. This whole thing seems like window dressing. But Alasdair, I'm thinking we're talking about what should be intelligent people, educated people who have studied history, and yet they're doing the dumbest thing under the planet. So it tells me there has to be an agenda. And now clearly, I always say to myself, why Russia? What is this obsession about taking down Russia, causing regime change, whatever they want to call it, taking it down? Well, clearly, the globalist agenda would not exist if we have a multipolar world. And you take Russia out of the equation, then you could probably deal with China. But to have those two powers, and as you say, one controlling a vast energy reserve, literally energy reserves that really, if you add them all up, whether it's multi-trillions of dollars worth of energy reserves to be traded outside the dollar, to me, this is what this is about.
Yeah, no, you're right. And of course, this is also, and this is something that has not been covered in the mainstream media at all, the end of the 50-year agreement whereby Kissinger and Nixon agreed with the Saudis to, provide them with defense, security for the nation, in return for which all oil would be sold in dollars. That agreement was a 50-year agreement. It ended on the 9th of this month. And so we're in new territory. And we know that the Saudis have probably broken this already anyway, because they've been selling oil to China. As I understand it, the settlements have been in yuan, at least some of them anyway. So I think that this is actually a major point. The oil for dollars really was, if you like, the ground upon which the dollar has stood since 1974. That's now gone. This could well accelerate. it is very, very concerning. There is another aspect in this, and I'd be interested in your thoughts too, and that is the demand for gold. We've been talking about it migrating from west to east, and particularly China, which is the Hotel California for gold. It never gets out of there. This has accelerated to the point where it's driven gold prices to record highs. In the West, nobody's buying gold. I mean, ETFs are declining. They're net sellers and have been. I think it's probably slowing down a bit. I mean, talking to people in the coin and bar industry, both in this country and also in America, business is moderate, let's say, rather than, we're just not buying it. Yet, when I look at China, I mean, household savings, 35% of GDP, that's $6 trillion. Where does it go? I mean, at the moment, property, rule that out. Stock market, unfashionable. It's basically going on bank deposit in banks, which also offer gold accounts. So, I can see that there is likely to be continuing and accelerating demand for gold. In other words, we probably haven't seen anything yet. I don't know. What's your view on this?
Yeah, I know. We hear those reports, and I know you've commented on this, Alasdair, because you're right at the front of all of this stuff too. And essentially, that when the mainstream media come out and there's an awful lot of reporting, oh yeah, China's come off the boil. They've stopped buying gold. Hang on, no, they've reported that they haven't increased buying their gold. But we know that they got 3.4 trillion of shadow bank reserves. We also know that there's a monetary thing called monetary gold, which doesn't have to be reported. So to me, and also when you think that China consumes all of their own gold supply, gold mines, what is mined in the supply, that forces the wholesale, the retail market to source bullion outside of China. So to me, that's what I'm seeing, which is, I'm sure, pretty much what you're seeing.
Yeah. And also with silver. Silver is an interesting one because I'd rather taken the view that China has been controlling the price of silver for a long time, really because it needs it as an industrial metal. But India has become a major buyer, really, again, for industrial purposes, because India is ramping up its ESG credentials. The government is encouraging and I think even subsidizing the production of photovoltaic cells. And so, Reliance Industries, one of the major conglomerates in India, has recently opened a factory which produces 5 gigawatts of photovoltaic cell output. Needs a lot of silver. And so where do they go? It looks to me like they've been standing for delivery on COMEX, where I think over 1,500 tons has come out this year. We're talking about quite serious quantities, and stocks in the vaults, free stocks as opposed to stocks which are actually sort of held by ETFs or other serious holders, as it were, long-term holders. That liquidity is actually diminishing very substantially. So there's a huge squeeze. And of course, nobody on the short side in the paper markets can close their positions. It is actually, I think I can see the possibility of a crisis in the bullion banking community. Not just on silver, but also gold, where they cannot close down their position. And if you look at the producers on COMEX, when we had the spike up to $1,900, was it September 2011 or 12?
Yeah, exactly.
The producers category was net short of about 200,000 contracts. This time, they're short of less than 50,000. So you can see that the burden is actually on the swaps, and they can't escape from it. They can't turn around and tell the miners and so on, look, sell your production forward so you can guarantee your cash flows, which is, the old story that they do. because, the miners aren't having it anymore. They're not idiots. so this is a squeeze. Yeah.
I think you're right. And this is unusual because we've never viewed the COMEX as a place to come and take delivery. However, you've just nailed it, because silver, because it's not NSFR compliant. In other words, you EFP silver into the local London market. If it was gold, it has to be Basel III compliant. It has to be fully backed. You T+1 that into local London on the gold side, then it has to be physically deliverable, and it is escaping. But so there's no point in going to the COMEX for, you can just literally take the COMEX derived price, take the fixed price, T+1 it, and away you go. You've backed. But silver, they don't have to. It's not NSFR compliant. So therefore, if I EFP silver into London, they don't have to give it to me. They'll just flywheel it, because that's the old game with gold. They just never had, they ring fenced it into their little world. And in fact, we used to get threats. UBS, this is some years back, but UBS said, you order any more silver, we'll blacklist you. And it wasn't just us. They were going to blacklist Julius Baer. And it's like, hang on a minute. This is this ring fence. So you're right. So they do go to the COMEX, because you can take physically delivery there, and you can fly it out relatively cheaply.
Yeah. It's and it's. I mean, this is what, the fourth year of a deficit in supply over demand.
Yeah.
I mean, this is not a new story, but I think it's reaching its climax. Is really what it boils down to. So Shane will be pleased. If I remember correctly, he's a silver man.
He just lives and breathes silver. He doesn't want to talk about anything but silver. So he will be pleased.
Yeah. So how are you seeing the trading in London? I mean, you've got your finger very much on that pulse. I'd be very interested to see how you read things at the moment.
What from this side of the pond?
Yeah.
This side of, yeah. Well, I think what's interesting is that obviously we've covered some of what's interesting, in the sense that this whole de-dollarization process. The fact is that Basel III, and again, on the 1st of January 2023, as we both know, as we both talked an awful lot about it, probably the only ones originally talking about it, and what it did was actually create gold as a first-tier asset that equally, in fact, more than equally, it competes with US Treasuries. It's a first-tier asset class. But when you compare the two, one is full of counterparty risk. The other one, in its physical form, owns nothing. It's all the energy that was ever put into those bars that represent that are in it. So therefore, it cannot be debased. And I think we're seeing to answer your question, whereas people said, oh, well, look, the market's still being manipulated. Hang on. No. It's actually reached a point where the physical markets are, as you said, being settled outside of this ring fence. Now, gold in particular, because it was T+1 it's become T+1 deliverable as of last week, is literally flying out. And so every first tier bank, and I've got a good friend at Goldman. I know that there's some various people that we talk about, we have coffees and stuff. And he says, well, there isn't any of a first tier bank that isn't long gold for their own book. And so they know something. And yes, they may act as agent for the Fed, because they're guaranteed by the Fed. So they do play these games. But it enriches them, because they end up picking up, they don't know exactly where to pick it up. So the game is really, to me, it's done. As far as the manipulation, it's done. And that's what most people fear. They keep saying, yeah, when's the next smash coming? Hang on. You're not settling it in the ring fence anymore. It's being settled outside the ring fence. So that's what I'm seeing, Alice.
That's a fascinating point there, because it was at the beginning of this week. No, when was it last? I think it was on Friday. They banged the gold price very hard after China had gone to bed, as it were. But when you looked at the volume on COMEX, I mean, it was derisory. But the interesting thing is that the open interest fell like a stone.
Yeah.
So, in other words, the job of trying to reduce the short exposure was actually a very successful raid, if you like, on the stupid longs. And that's all it was. And of course, now we're sort of recovering a little bit. We've got the Fed meeting this evening. It's not expected that there will be anything coming out of that. However, what's interesting is that Lagarde lowered the ECB's deposit rate by 0.25% last week. Now, not that I've got a lot of respect for Lagarde as a banker, but I would doubt if her office hadn't been talking to opposite numbers in the Fed, in the Bank of England, Bank of Japan, so on and so forth, before taking that decision. So, it could indicate that these guys are getting together to try and force the rates down without, hopefully, from their point of view, encouraging a resurgence of inflation. But that ignores actually what inflation is. It's a falling purchasing power in the currencies, which is actually why gold appears to be rising. It's not gold rising, it's these currencies falling. And, people so often make the mistake of, thinking that the People's Bank of China is buying gold. No, they're not. They're selling dollars. That's the way it is. But it is possible. I just think it's possible that the central bankers might be trying to get together to force a small fall in interest rates. They'll never get more than that because the whole system is just tottering on the brink. I mean, you've got, the commercial real estate business in America. We've got all these things, zombie companies. We underestimate the degree of zombiness, if you like, in our economies, which all come about from suppressed interest rates. On top of that, I mean, the central banks themselves are deeply underwater in terms of real losses, embarrassingly so, when you expect them to underwrite the commercial banking system, which is over-leveraged. The easy way out is to try and get interest rates down. I just wonder whether we might see a slightly more concerted attempt in that direction a bit sooner than we probably expect. But, if they do it, I mean, gold will go through the roof, I think, because the inflationary implications are just, just unreal. Just crazy.
Do you think, because again, do you think it's obviously all these jobs numbers and if you drill down into them, they're just such hocus pocus. I mean, it's actually voodoo economics to me. So basically, do you think this is really, because it seems to me politically sought, everything. And I think it almost seems that it's so politicized that one way or the other, they're going to do what they have to do to prop the stock market up, get Biden a chance of getting a vote. And if it all falls apart, Trump has got hell on his hands to deal with. Do you think that's right?
Well, I don't think they're trying to sort of accelerate the decline or anything like that. I think they're generally frightened of the position they find themselves in. I mean, for years we've been talking about kicking the can down the road and so on and so forth. And, the can is not getting kicked anymore. It's not going anywhere. I think that people in authority are genuinely frightened of the situation, which they find themselves having to deal with. I mean, this sort of, we can all see it, which is why we all turn around and say, they must be conspiring to do this or that or the other thing as the only way out. But that sort of speculation, I think, is wide of the mark. I mean, just bear in mind these guys. There is really nothing they can do. They don't understand necessarily how they've got themselves in this position because, they're pulling the levers, the economic levers, and nothing is happening. But it should be happening. They're still in that sort of mode. They're not sort of thinking, Why doesn't it happen?
Yes.
I mean, we pull the lever. Why does it not work? We ought to rethink this. They're not at that stage at all. And they actually don't have the time to deliberate on this. And it all goes back to, if you like, the sort of socialism versus free markets. I mean, okay, free markets, not necessarily perfect, but they're bloody sight better than what we have. And that's actually what it boils down to. So, you can be a central banker and you can understand free markets as much as you like, but can you persuade your politicians to do so? No way. I mean, I actually spent a day with the central bank in Scandinavia. I won't say exactly which one, but and I was talking. Really, I was called in to talk to the board, the foreign exchange department, the payments department, all the rest of it, and give an overall presentation to the bank. And I told them that interest rates are going to rise because the banks are no longer lending. Which basically means that the price of credit goes up. I told them about the debt trap that the US is in, and this country's government economics, government finance position is actually very, very good. But I said, look, it doesn't matter because, if the dollar goes down, we'll go down. So that is, the dollar is the king rat of currencies. And they understood that. Then there's another conversation, which was fascinating. This government has very little debt. I mean, we're looking at a debt to GDP in the order of about 35%, something like that, which, compared to us, over 100. I mean, that's dreamland for us. Yeah. Anyway, but the problem is that it's the private sector which has got the debt. And they have had a policy of restricting rentals, the rental market. So there's virtually no rental market at all. So if you want to have a roof over your head, you've got to go out and buy property. And the result is that particularly with, the sort of zero interest rate situation, the leverage, the financial leverage that people are in is just absolutely enormous. We've got the same thing here, the same thing in America, same thing everywhere. It's a point worth making. We get a rise in interest rates because of the inflation situation, because of the government debt situation and the requirement to fund that at anything up to over 10%, maybe 15, maybe even 20%. That is going to basically bankrupt home ownership where mortgages are involved. And if mortgages are not involved, the collapse in the values for property, for residential property, will spread to those who don't have mortgages. I mean, this is not going to be a nice situation at all. And that was very much drawn to my attention in my discussions with this central bank. I mean, this is a concern. What do? I said, have you not spoken to the politicians about this? And said, yes, we have tried to encourage them. We told them we must have a rental market to take the pressure off. But the politicians refuse. They refuse point blank. And when I see, our charming Mr. Gove as Chancellor of the Duchy of Lancaster trying to introduce restrictions on landlords, I think, there's a slight echo there of what's going on elsewhere. This is a debt situation which leads to the collapse of the value of credit. That is the key thing. And that means that you've got to get out of credit. And I don't care whether it's bank credit or currency, fiat currency. You have to get out of them and you have to get into gold and silver, which are legal money going all the way back to Roman law and is embodied in everyone's common law. And the only reason we think it's a pet rock is because we've been told to think it's a pet rock by a US government determined to protect its own currency. It's the end of the road, I think, Andy, and this could happen quite quickly. I mean, I'd very much like the idea that this is not going to happen suddenly and it's going to be horrid and all the rest of it. But, you look at the geopolitical situation, us moving towards a warlike stance, which is totally unjustified. I mean, just the overall stupidity in the system I mean, we're like lemmings running off a cliff, and the destruction of credit I see as something that can happen very, very quickly. So I don't know there's a huge amount of time left. And so our function of trying to educate people, get them to understand actually what is going on, we've got to up the pace, I'm afraid.
Do you know, and you will know this because we lived through the 1980s. And I remember
1970s in my case.
70s, yeah, 70s, 80s, exactly. And so we had interest rates up to nearly 20% at that point. And what happened was, I mean, for example, I went, had a school teacher friend in Gloucester, and I went to visit them, and it turned out that every single house in that entire development had stopped paying their mortgages simply. And the banks had come in and said, no, we won't repossess anything because we cannot mark that to market because that would have imploded the entire system. And I think what you're talking about is this can happen so quickly and so rapidly. And it's happened before. It happened very, very quickly. It caught an awful lot of intelligent. We're not talking about deadbeats here. We're talking about intelligent professionals who can no longer afford to even pay for the roof above their head. And when you think about it, is what we're saying here, what you're saying is, well, have you taken any steps to protect your wealth? Because what you're doing, if you're going to buy into this debt-based system, i.e., you're not going to dispose of what available. I mean, obviously, people can't suddenly dump all their cash because they need it. Not everyone's in a position where they have enough to actually invest in gold and silver. But essentially what you're saying is, if you can do it as much as you can, you need to do that, because I'm hearing this from you.
Yeah, absolutely. I mean, the problem with this, of course, is that, quite some time ago, I saw a statistic that 70% of the employed workforce lives paycheck to paycheck. In other words, they don't have any savings. They can't put anything aside. Mm. And that makes it even worse because, rising interest rates, rising mortgage rates and all the rest of it, it's already squeezing them very, very badly. I mean, as to your point about people getting behind on their mortgage payments, it's going to become a question, I think, of, individuals are going to have to manage the relationships with their building societies and all the rest of it. I mean, building societies and banks, as you rightly point out, are going to be constructive on this. I mean, it's the old story, owe £100 to the bank and, you've got a problem. Owe £1 million to the bank and the bank's got a problem. That's really what that's what it boils down to, with everybody being in the same boat. They're going to, the way to manage this is don't just, if you like, put your head in the sand and all the rest of it, but get into a dialogue with the bank, because the bank or the building society will recognize it's got a problem. It will not want to foreclose. That is the last resort. And, when this begins to snowball into even greater numbers, it's not even going to be a last resort. The whole system will have to be underwritten by the government, in effect. That, of course, leads to the dilution of the purchasing power of the currency. I mean, the liabilities coming down the road are just increasing all the time. But this is, if you're going to keep the roof over your own head, I think you're going to have to think seriously about your relationship with, your bank, your mortgage provider, whatever. But that is rather beyond us. I mean, we're just talking about an economic scenario which we can already see is beginning to arise. But for those who can afford to do it, who don't have these obligations, I think there is an increasing urgency in order to get out of credit as much as possible. And credit is not just a bank deposit. I actually don't worry about bank deposits. I mean, you've got money, if you've got currency sitting in, say, NatWest Bank, which is half government owned anyway, that's not going to go bust. They're going to do anything they can to stop banks going bust. Let's face it. So, but the problem is the currency. The currency is credit. It is an obligation which is owed to you by the central bank. Now, I mean, I have economists, even Austrian economists, who, don't actually understand that point. They think that, the currency has actually replaced gold as money. And consequently, they ignore the fact that there is a balance sheet entry on a central bank's balance sheet, which shows currency as a liability. A liability to who? To you and I, to the extent that we own the currency. So that is credit. It is credit with a counterparty, and that counterparty is going to dilute your currency because of the obligations which that counterparty now has. This is going to be, it's whichever way you go, it is destructive of fiat currencies, and it is the ending of the fiat currency era hoving into view.
And I think one of the elephants in the room right now is that, for example, dear Alasdair, if you were the head of the Fed and you were literally borrowing $1 trillion every 100 days, and then you said to me, "Will you take my IOU?" And of course, this is what central banks essentially. This is what other central banks are looking at and saying, "Well, why would I take that IOU?" Because it's almost like this could actually end up to what happened to Liz Truss when the entire thing collapsed. Is that there comes a point where people are going to say, "No, I'm not buying that bond anymore." And when they stop buying that bond en masse, then your 15% that you outlined is coming. How quickly could that come? That could come very, very quickly.
It could come very quickly. And I mean, I say sort of 15% because that's what we went to. We had 3 gilts issued in the middle of the 1970s, the 15s, 15 and quarters, and the 15 and a halves of 98. That sort of coupon is absolutely inconceivable with debt to GDPs, in America's case, of 130%. In our case, 100 and bit percent. France, 120? Italy, 144? Japan, I mean, for goodness sake, 260 plus. So this is, it is. I think we're looking at the end of the road for the fiat currency system. I can't really come to any other conclusion. And there is nothing the Fed can do about it. I mean, the idea that the Fed controls interest rates, no longer. I mean, you and I have been around long enough. We know old hands in the city, who will tell you that the market always wins out in the end. And it will again. It's something which the current crop of investment managers, economists, investment strategists, and all the rest of it have completely forgotten.
Well, I think, this is really a wake-up call because, and I think, there's no drama to this. This is simply fact. What we're talking about here is a concatenation of events that through historically have accrued to a point where it's actually not solvable in any other way than you've just described. So therefore, obviously that brings us to gold and silver. And before, obviously, I know your affinity to it. I know what you've talked about. You've been early in the game here to talk about you need to protect yourself with physical gold, physical silver. But what do you think about, and it's, again, this is not a trap question. What do you think about Bitcoin or versus gold? Because a lot of people seem to think that Bitcoin may assist them along the way, but I don't know. It's not, because it could be a love-hate relationship. If you say I don't believe in Bitcoin, then you're going to make enemies. So I'm always very careful. I mean, I often say, look, it's a fellow traveler, but really, physical gold is to me the only asset class other than silver. But what's your thoughts?
Well, I mean, it is an extremely good question. I think the people who are talking about Bitcoin don't actually understand the relationship between money and credit. We never, ever spend money. And by money, I mean, gold or silver. I mean, except in the form of small coins, maybe, in the old days it was copper coins. Now, even that's debased. For goodness sake, there's no silver in our 10 and 20p things. There's no gold in anything. There's no copper in any of it either. So, all that has been debased. So we work entirely on credit. It's credit which has actually allowed our economies to progress to the point where we're living like kings compared to the kings, say, of less than 100 years ago. I mean, the quality of life we have is absolutely fantastic, and that has been because of credit. Now, the point about a gold standard is that the credit's value is tied as a gold substitute, if you like, to the value of gold. And the value of gold doesn't really rise, it doesn't really fall. Over the long term, it fluctuates a little bit, but it is very, very stable. The reason that gold works as a standard is because of that stability. And that stability is fed by an expansion in the quantity of above ground stocks, which keeps roughly pace with the expansion of the world population. So that is the way it works. Now we talk about Bitcoin, which has got a hard stop on it of 22 million units. And quite clearly, that will not work as a standard for credit. I mean, can you imagine, let's say you have this wonderful idea, you're going to build a shoe factory because, you know your business, you know the shoe market, you know what people are likely to want in, say, 3 years' time, which is how long it will take you to put the factory together with all the machinery, the skills, the expertise, the management team, whole caboodle, okay? I mean, 3 years, actually, it's probably more like 10 nowadays with all these bloody regulations. But anyway, let's assume it's 3 years. Okay, if Bitcoin is the standard against which you will borrow the credit from the bank, what certainty do you have in the economic calculation for, so at the end of the day, you can calculate, what the value of the final product will be, measured in Bitcoin substitutes, okay? What's the value going to be? Is it going to be up, down, sideways? There's no stability there. You can't make that calculation. If, with this hard stop, over time, obviously, any expansion in the economy would mean that the value of those Bitcoin would rise, and with it, the cost of repaying your loan. Or even if you've got your Bitcoin or whatever, if you have the credit in order to do it already, then you're looking at a situation where you're looking at a return on capital. You're not going to get a return on capital. It's going to be a negative return. In other words, it does not work. It really does not work. There is a further problem with this, and this is a legal problem. The Romans actually set out the law about, if you like, the difference between something which is, a mutuum and something which is a deposit. And basically, the way it works in English law, I'll say in English law, and I think it's true in all other laws as well, is that if you have, let us say, a work of art on your wall, someone steals it, and you can identify that work of art. Someone bought it off the thieves or bought it through an auction, not knowing it had been stolen. It's still your property. And there is absolutely no compensation whatsoever. I mean, this is the basis in which Jewish families who were robbed by the Nazis in the Second World War have been recovering their art, and possessions. Now, money is different. Somebody, let's say, steals your wallet, and your wallet's full of lovely notes and all the rest of it. You take that wallet down to a shop and goes and buys cigarettes, booze, whatever with it. You have no right of action to recover your notes from the shopkeeper, okay? Now, you would think that Bitcoin acts as money, but there's a big question here. It's actually identified, every bit of it is identified as if it was a work of art by the blockchain. We know what the ownership of that is. We know the history of ownership. Right, let me put an idea to you. Let us assume that the Bitcoin which you bought through an exchange was previously owned by someone who, as far as some government was concerned, acquired it through, by stealing it, or the proceeds of crime, or tax evasion, or whatever, and then comes and claims that off you. Now you've really got no alternative but to submit those back. And the question then is, would you get compensation or not? I think probably the answer is not, because of the legal precedents. Anyway, it's not something I would like to put to the test. So that's my view on Bitcoin. It doesn't work practically. And also there is this big legal question over the status of it as property.
That's a really insightful answer. And I think I don't think I've heard anyone actually look at it in such an insightful way. And I think so really what you're saying is open your eyes, look, study what you're buying. I mean, if this is the point, is that often people just follow the herd and they don't understand what they're actually investing in. They don't, well, everyone else is doing it. I'll go on Yahoo and says that everyone's buying this, so I'll buy it. Well, of course, what you've just explained here is here's the risks to that. And so if you want to do that, then you better make sure you're hedged in some other way. If you want to diversify, there's nothing wrong with diversifying. But again, there's a risk. And I think this gets us back, Alasdair, to the one and only, well, really, there's only, in physical protection terms, there is only a couple of answers. Gold, physical silver, other perhaps rare earths and one thing and another would be a part of that. But as something that is infinitely easy to value, fungible, anywhere globally in the entire world, my piece of gold, my coin, my piece of silver, it's the same value to everyone all over the world at the same time. And I think what we're sort of getting to really here is the essence of it is that what are we going to do? We've just outlined a lot of issues here. And it could end up in a world war. We don't know what's going to happen. And none of us know this. But we can take steps. So we can take responsibility for ourselves. We can take steps. And obviously, I know, and everyone knows you, Alasdair, that obviously you've been a great advocate of gold and silver. But I would ask you one extra question. At this point in time, with silver so deeply undervalued, below its all-time highs, etc., and in a supply deficit, and you've just explained a huge upsurge in demand for this product, would you actually weight silver a little more against gold at this point?
Yes, I would. I mean, we're sort of, if you like, treading on the toes of investment advice a little bit. So I want to make it absolutely clear.
Personally,
we're not
just personally.
This is coming up with opinion rather than advice. I mean, it's a fascinating situation because silver is not priced as money at all. It's not valued as money. I mean, if it was valued as money, we'd be looking at a gold-silver ratio back in sort of, Sir Isaac Newton's levels, sort of 15 times, whatever. So it's definitely not. Yet, the thing that's fascinating is that when gold runs, silver runs twice as fast. So it does have this sort of moneyness, if you like, inside it, even though it is not priced as money. Now, on top of that, of course, we've got, as we were talking, we've got the shortages and the squeeze in the paper market and the lack of liquidity, which is driving the price. I mean, I can see silver actually going more rapidly than twice as fast on the upward direction as gold. So, for people who can stomach a little bit of risk, and there's no sort of extra return without some sort of risk, then it actually could be a good way of getting to gold. Go via silver. If you can take the risk, go via silver. I would expect to see silver outpace gold, certainly until you get the silver gold ratio down to somewhere between 30 and 50. I can't be more precise than that. At which point, I think I would probably reassess the position. I personally have quite a bit of silver for that reason. I want to get as much leverage on the gold thing without going to a bank and saying, look, here's my collateral.
Yes.
I've no longer got it. I don't want to go into that game. No, thank you. I really do think that silver has a role to play here. And in the very, very short term, there is no doubt that this ESG rubbish is creating enormous demand for silver. There is no supply there. And on those grounds alone, it's going to drive silver a lot higher. And it's going to break the markets. And this is something actually I'd be very interested in your view, Andy. What I see is after 40 odd years of paper markets and the actors in those markets being entirely used to a situation where delivery never really takes place. And it's just credit. The whole thing is done on credit. It's a mountain of credit, which can be expanded, contracted, whatever. We're now in a situation, I think, where that credit is now being encashed for physical. This is really what it boils down to. I mean, we see the deliveries on COMEX, which is never meant to be a delivery market. We see how this stuff is being drained out of the West into Asia. So we're looking at, I think, a potential crisis in the paper markets, which could actually take out the bullion banks. Your views, please.
Yeah, and I think in simple terms, if from an arbitrage perspective, if I can get $4 more for my silver in Shanghai, then I can see a split happening in this cartel that has kept the price down because it suddenly gets a little bit too attractive. And obviously, we know that there are backdoors into the big banks have backdoors into China, and it just gets a little bit too attractive. And I think a $4 premium, that's a hell of a lot. If you can take a COMEX contract and basically to $20,000 more per contract, you can get by shipping it through a backdoor, maybe with a little bit of friction. But that's the answer to me right here and now. Why is that kept going? Because, as you've said rightly, and you say it yourself, the physical markets are now being settled outside of the CME LBOA ring fence. So we, the West, has become price takers, and SGE has become a price maker. Yeah. And I think, to me, that's the answer to everything. To me, because I think that's where the physical prices are being settled. They're no longer being settled in the West. Yeah.
But this is, when I look at the position of the swaps on the COMEX contracts, and I assume that there's a similar situation in London because, we are talking about a credit market, let's face it. I just wonder whether, banks can survive this transition from paper to physical. It's because they just don't have the physical to stand for delivery or, to deliver, as it were. So, with, the sheer weight of demand from the Chinese public, I think earlier, I pointed out that, there's something like 75,000 tons is the equivalent of the savings that are being added to the Chinese economy by households. 75 1,000 tons of gold is the equivalent. Now, it's obviously not all going to go into gold because the gold isn't there, but it gives you an idea of the sort of pressure there is for higher prices. And it seems to me, I mean, it's an interesting one because under normal circumstances, you would expect the purchasing power of paper currencies to drive the value of gold valued in those paper currencies. But we could be moving into a situation where this sort of imbalance between, the Chinese demand and the supply in the rest of the world could actually force the pace, raising the value of gold, if you like. I don't like the word intrinsically because there's no such thing as an intrinsic value because you value something against something else. But, on its own, gold in terms of its purchasing power could increase very substantially, measured in commodities, oil, goods and services, whatever, because of this factor. In other words, it's not just the paper currencies driving towards their own demise. There is also an end coming from the gold side as well because of this accelerating demand from the Far East. And the thing that's also interesting is Singapore's situation in this, because Singapore, the government has been importing gold. I understand from one of my ex-colleagues that Singapore is likely to be the big vaulting center in the Far East, which makes a lot of sense. I mean, outside China, Hong Kong is in China, in effect. So, outside China, where are you going to, Singapore is the Switzerland, if you like, of the region. So, and I think a lot of the market activity, futures trading and on a settling, on a trade to settle basis sort of thing, all that's going to happen there. We're yesterday's story in this, and I just wonder how our system will survive that transition. I have grave doubts that it will.
Yeah, especially when you see many people just don't even bother to look at the Office of the Comptroller report, where you've got very close to $500 billion of derivatives, just basically in the hands of the top four banks. And so, so really what we're talking about here is a synthetic price. And I think this is something that I drew when Andrew Bailey was the head of the FCA. We actually in July 19th, I think it was, of 2019, we had read out in Parliament. We can't believe the Speaker actually read that out, but we actually read out. We've got Jeremy Lafoy, the Member of Parliament, to actually read out the concerns to the Treasury. What do you realise that there's this huge position, a derivative position, and one in particular he raised was the ability to roll 14-day forwards ad infinitum without reporting them. So the close to $500 billion of the OCC report doesn't even count for what's being incessantly rolled. And what was interesting, we had meetings with the Bank of England, with the head of the FCA then, Andrew Bailey, the Treasury, it went to the DOJ, it went to the CFTC. Nothing happened. Clearly, nothing's happened because this position still exists.
Yeah.
And when we saw the gold price getting nailed below, it is pretty clear that the Fed or the insiders, so whoever's short, is short on the wrong side of 2,300 gold. So they wanted to get it below 2,300 gold. They wanted to get silver below $30. So really, you've got the COMEX positions, which is what's so interesting, because I don't believe anything else about the COMEX reports. They're so delayed and they're so outdated. But they mirror this literally what is $500 billion plus of other derivatives. And these same positions relate directly to the COMEX, which is a fraction of that size. But when you see 2,300, the bets on the wrong side of it, on the silver, no wonder we went down and tagged. Guess when we tagged 2,300, sub 23, AM fix, Monday, when China wasn't there.
Yeah.
Right. And what I did was trigger a bunch of central bank buying, waiting for these fools to bring it to them. And to me, this game is so well known now. And everyone's looking at these and saying, these guys are boxed in. So let's not blow it, but let's milk them. And I think that's what we got.
Yeah, yeah. Fascinating. Absolutely fascinating. Yeah. Well,
Alasdair, you know what? You've been so generous with your time. And I know people start tuning out after about an hour. So, because it's too much to take in. It was, but I will suggest people listen to what you've been talking about more than once. There's stuff in there really, which is got my attention. It's such an interesting thing. But I think, Alasdair, when people want to find you, I know that you have a Substack channel of your own. Can you tell us a bit about it and how people can access it?
Yeah, sure. I mean, as we've sort of discussed, I feel, and you obviously agree, that there's this urgency to inform people, to educate people, to help people understand the dangers to credit. And it's really with this in mind that I set up the Substack channel. And I also find from my own personal experience that if you actually get off your backside and pay for something, then you pay more attention to it. So I'm strongly encouraging people to come as not only as free subscribers, but if you can afford it, pay for it. It's not a lot of money. I mean, it's $2 Starbucks a month, in London. So, which is not hardship. And I think, by providing the information, educating people, helping people understand the difference between money and credit, which is really what we're talking about, and the dangers of credit, to understand real economics rather than the government version of economics, if you like, and what your investment managers will tell you. To understand all that properly, I think is vital, and it's getting more and more vital as anyone who's actually listened to this towards the end will hopefully understand. So that's setting up Substack. It's Alasdair Macleod.substack or Macleod Finance Substack. Google it, you'll find it. It's going well. I mean, I got over 6,000 subscribers now. So
super.
And it's early days. And I mean, the thing that's interesting is that there is no bullishness in the West when it comes to gold and silver. People aren't saying, I want to know what's going on in gold and silver because it's rising, but should I have some? There's none of that. That's the sort of behavior at the bottom of a market. And yet here we are, at new highs. This needs explaining. It really does, Andrew. And I think you've done a very good job of it too from the market end. So
we'll put the
that's
link
what I'm
in.
doing. And I'm still writing for Goldmoney too, by the way. But my emphasis is very much It's very much more on the Substack because I've got a wider remit, if you like, with that, which is really what I want to achieve.
I would encourage people to click on the link, which is actually in this episode or below this episode. So, and to look, come and check you out. I mean, this is, if you want a bit of Alasdair on a daily basis, that's how you do it. And as I say, so you've got a great view on, to me, it's second to none. And, your take on things, the ability to digest a huge amount, not just, it goes all the way back to throughout history. And what you've done is connected a lot of the dots here. Nothing is new. Everything has been done before. And really what you're doing is you're pointing out to examples of why, understanding why is very important because then I can make decisions for myself. I'm not listening to anyone else. I'm just understanding more about.
Absolutely. Yeah.
And this is what it's about, education. Alasdair, you are second to none when it comes to education. I really would suggest people do come and check you out.
Yeah. Well, thank you very much indeed. And, we'll do it again soon, hopefully.
Absolutely. Oh, I always look forward to it. Thank you, Alasdair.
All right. Thank you, Andrew Maguire and Alasdair Macleod, for another fascinating discussion. And to our Live from the Vault community, remember to buy physical. Make sure it's physical, backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault. So please keep spreading the word about this channel. Keep it growing by hitting that like button, by sharing, and by subscribing if you haven't already subscribed. And if you want to get this information in real time as each episode goes live, you want to be notified, just click on that little bell right there and we'll do just that. And with that, we'll see you right here next time on Live from the Vault. See you then.